Welcome back to our Nature of Society course. We have covered 3 sessions thus far, and I'm sure that you will agree that your knowledge base has expanded somewhat over those past 30 sessions. This term, and for a few sessions henceforth, we will be adopting a more practical approach to the subject. How can these lofty tenets and principles of economics be applied to everyday life in your or any country? We will begin this term by looking at the issue of banking in society. Whatever you may think about the banking industry today, it is without doubt that all is not happy with the services that banks provide to citizens. Because of this, there has been many innovative iterations of the service developed over the years to meet this expectation gap. But to date, nothing has arisen that truly meets the needs of the common man. Banking is a very critical service in any society as the capital factor in the factors of production that produce wealth is provided in the main here. We must, however, give a brief history of the banking industry to fully appreciate this. The start of banking can be traced back to 2000 BC in Assyria and Babylonia, where the meeting places were used in the centers of towns and villages, where persons brought their produce and livestock to be traded for other desired produce and livestock, a process which was called bartering. Over time, this bartering proved highly inconvenient and cumbersome, since it was very inefficient in giving one the wherewithal to acquire all that one desired or needed. There would have been an excess of some items not bartered, as well as some items that were needed but not available or already taken. This type this type of bartering marketplace proved to be highly ineffective and inefficient. In these circumstances, that if a medium could be provided that could act as an intermediary and be accepted as universally valuable, this could provide the efficiency and effectiveness that were missing in the barter markets. Eventually, gold was that medium and intermediary that was universally deemed precious and mobile enough for transaction purposes. Produce, livestock, and other goods and services were exchanged for a particular weight of gold according to the agreed value of the good or service. Gold was made into gold coin to facilitate and standardize value of transactions. Soon, goldsmiths occupied a prominent position in the marketplace, being the persons who deemed the weight of gold and who fabricated the gold coin. A trusted few were given the privilege of storing and safekeeping the excess gold of traders, and a literal bank of gold became available to some traders who were doing very well in the marketplace. These trusted goldsmiths became the trustworthy bankers of the precious metal, and over time and reputation became the official bankers of the community. Traders themselves found it more convenient to pay for their goods and services by simply giving their suppliers a note to take to their bankers to pay the specific sum for items. This note would have been probably how check payments started, with the notes included the words, promises to pay the bearer on demand, and this would have been backed by the trader's store of gold in the bank. Bankers soon realized that because of the general trust that the community had for them, these promissory notes could be converted into paper money for use by the wider citizenry, with the general belief that this paper money was in fact backed by gold and held in the vault. What should not be lost on us in this anecdote is that this paper money is really backed by the production of goods and services, wealth produced, and not any gold that is resting in the bank vaults. And this is how banking began in earnest. Instead of exchanging the promissory notes for gold, the bankers simply used their banknotes as further legal tender for transactions in the community, And with the proliferation of banks, these notes were deposited, used as exchange between banks, and at last became the common currency of doing business. The original gold currency was simply parked in the bank vaults and forgotten, and trading now took place exclusively with these banknotes. Bankers soon found that they could offer these notes to persons as loans once they were contemplating producing tradable goods and services to the rest of the community. These loans were not backed by any gold in the vaults, but by the simple belief and trust that goods and services would be produced that were needed by the rest of the community. These loans were very popular and were largely responsible for the agricultural and industrial revolutions of the 17th and 18th centuries, respectively. Persons seeking these loans were made to have to and put up security of some sort because, as indicated, these loans were not backed by any gold whatsoever. These securities, which were deemed collateral, would have been in the main in the form of property on lands of high value. Should these ventures fail, these securities would have been forfeited in lieu of the loan payment, of the loan repayment. Here again, that the banks and maybe the state itself would have failed in not insisting that the loans be backed by the production of goods and services and not high value property. The society would have been in a far better position with the increase in wealth produced rather than the forfeiture of property. Over time, and with the passage of the cycles of boom and bust, the community would see the effect of this forfeiture policy with a society that is laying waste. Site value taxation would ensure the continuous production of wealth, even if the businessman or trader is to have his loan facility removed. The point is that the policy must be the continued production of wealth. Let us have a short break now. Here we have one of Henry George's most famous work, Progress and Poverty, written in the middle to late 19th century, and it's well worth reading. It's a classic in political economy. The forfeitures policy over time allowed the banks to increase their asset base exponentially. Indeed, they offered ownership shares to the very traders and businessmen who would have had large deposits in them. Valuable property was seen as excellent security, and financing risks minimal as properties, when forfeited, could be sold off in the future for prices multiple times higher than the value of the loans defaulted. To minimize the risks, banks developed a bias for lending only to wealthy customers, leaving many persons without such means, without capital to produce or purchase wealth. This then is another default of the state in not intervening here to ensure that all tradable projects were facilitated with capital for the production and general augmentation of the wealth in the community. More will be said on this later. It cannot be gainsaid that because of the greater access to capital afforded to wealthier persons, This indeed increased the gap between the rich and the poor and will continue to do so if it remains in place. Notwithstanding this bias, within recent times, banks have been found to engage in risky lending. Certainly in the period 2000 to 2008, this has been the case in the US, which resulted in the deepest recession since the Depression of the 1930s. This risk could have been thwarted if the risky loans were traded by tradable goods and services, which could only have been possible under a side value taxation regime. Many developing countries took advantage of these large loans to start very large projects without the proper audits being carried out. With the inevitable boom and bust cycles that occurred, many such countries found it difficult to repay these loans. In the US itself, this risky lending was prevalent in the housing market there, and these risky loans themselves were sold to banks in, in Europe. This is how the risk was spread globally, by risky loans conceded to the developing countries and the risky portfolios sold from the US to Europe. Many banking and finance houses were rendered insolvent, and many of them were deemed too big to fail, and were thereafter rescued by their respective taxpayers. Many persons lost their holdings on the stock market on both continents, and many also lost much of their life savings. And with the stock markets losing at least half of their values, the world was brought to another Great Depression. Governments then resorted to printing money, pumping same into their economies, in the belief that money would become available to service debts. What this has done is that it has broken the cardinal economics rule that money must at all times be backed by the production of goods and services. With this rule broken, we are sure to have inflation, hyperinflation, devaluation, and the debasement of the currency. A similar effect takes place when valuable lands are unemployed, underemployed, or for whatever reasons rendered inaccessible to produce goods and services. So let's return to the question of the true and rightful role of banks in a country that wishes to optimize its development. We should begin by asking the question, what do banks do in a community? They essentially take deposits for safekeeping from individuals, corporate citizens, the state, through its various ministries, corporations, and departments, and even foreign nationals and enterprises. They subsequently lend this money, capital, to whoever qualifies for such loans at such lending rates which turn a profit and provide dividends to its shareholders. Many of the ordinary folk who place their savings into such banks find it hard put to qualify for loans for their many needs and wants. Many of these folks neither have enough savings no collateral to qualify for loans. These persons occupy a broad range of the artisans of skilled workers who virtually build the community: plumbers, masons, electricians, carpenters, furniture makers, factory workers, clothiers, and many small business owners. Because of the unique service that banks offer to society, they have the unique responsibility to augment and assist more directly in the production process, but by providing loans primarily for development purposes. Today, banks provide primarily for consumption, and in a side value tax environment of necessity, this would change. This would have to change to loans that facilitate production. Loans biased towards production would do two things. It would firstly encourage savings, and citizens would develop the thrift and prudence to purchase items for consumption out of their own pockets rather than other people's pockets. Secondly, it would provide more available capital for production and development purposes on local sites and would reduce the overall risks that banks now carry, as the cardinal rule of loaning money only when backed by production is observed. Banks would now focus its attention on sites that are producing rather than consumption of goods and services. This would have a revolutionary effect on how they now do business and would cause them to acquire new skills which they do not now have. More on this later. We will end it here today, but during the week, have a look at how banks conduct their business and determine whether it is adequate, and if not, what should be their modus operandi to better facilitate optimum production in the community. Come back next week and discuss. Next week we will continue our discussion on banking. Before we end, I would like again to let you attendees know that Unsustainable Development is an educational offering devoted to the dissemination of its course to all of mankind and to those who have the English language as their official language in the first instance, and to all eventually all over the world. We have in fact been sending this course all over the English speaking world and with very favorable responses. To make this possible, and because we do not charge a fee for its dissemination, we rely wholeheartedly on monetary donations to meet the cost of achieving these goals. If you have found these sessions useful thus far and would like others to have access to them, we would gratefully accept your donations should you be inclined to offer them. You can send donations to our PayPal account at the email address notebroker2001 at yahoo.com. Thank you for your kind gesture. As indicated before, you can communicate with us by going to our Facebook page on Sustainable Development or YouTube channel, Balancing the Economy. We will respond to all your comments or questions. You can also subscribe to our YouTube channel and press the alert button to get notices that our latest session has been posted. All sessions are archived at our Facebook page. Please share with your family, friends, and acquaintances.